Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the key reversal candlestick pattern, essential formations that can signal major shifts in market trend. Understanding this pattern can give you a significant edge in identifying potential reversals before they happen. So stick around as we explore 4 crucial patterns that every trader should know to enhance their trading strategy, improving their results, and making sure to watch until the end of this video to fully grasp how powerful these signals can transform your trading strategy or your trading approach too. Now, the first pattern we'll be looking at is called the hammer. The hammer is a key candlestick pattern that signals potential reversal in a downtrend. It signals potential reversals in a downtrend. So the first pattern we're talking about is the hammer. How do we? It shows that sellers push price lower but buyers step in and drive the price back up near the close or near the opening level by the close. This shift suggests the downtrend might be weakening. To spot a hammer, you look for a small body at the top of a candle, a very long lower shadow, and at least twice the body length. The shadow should be twice the body length. Minimal or no upper shadow typically appears at the bottom of a downtrend. The candle color isn't crucial, but a green hammer indicates stronger buying pressure. For trading, for trading, wait for confirmation if you are trying to trade this pattern. But before that, let's spot the pattern on our chart, and I've already marked out areas where we will spot this pattern. And as we can see, they are typically at the end of a downtrend. And you can see this is the first hammer. This is a hammer at this area, this particular area. You can see a hammer. How to trade them? We trade them by waiting for the confirmation. A bullish candle should close above the hammer. After we see the hammer, we wait for a bullish candle, a bullish candle to close after the hammer. This is when we enter our trade. After the closing, after the candle close above the hammer's high, that is where we decide to enter our trade. This is where we enter our trade. This helps to ensure that the pattern isn't a fake pattern. After waiting for the bullish candle confirmation, it confirms that this pattern is not a false signal. As you can see, after this pattern, price decided to reverse and go to the upside. So this is for the hammer. The next pattern we'll be looking at is the engulfing pattern, the engulfing candlestick pattern. Now, the engulfing pattern is a 2 candle formation that signals a potential reversal in market trend. It consists of small candle following by a large candle that completely engulf the previous one, indicating a shift in momentum. Now, for a bullish engulfing candle, it appears in an uptrend. Talking about the bullish engulfing, it appears in an uptrend. The first candle is green. It has to be a green bullish candle. The second candle is a red or fully engulfs the it has to be a red, or the next candle has to fully engulf the previous candle, whether it's a green candle or a red candle. But the engulfing candle has to be bigger than the previous candles, suggesting buyers have taken control and potentially showing a reversal to the bullish side. Why the bearish engulfing appears at a downtrend. The bearish engulfing appears at a downtrend. First of all, the first candle can be a bullish or a bearish candle. The second candle has to be a bearish candle and has to fully engulf the body of the first candle. This candle has to fully engulf the body of the first candle. This indicates that sellers are gaining strength and possibly reversing to the downside. This is what it means. Now let's plot this on our chart, and as we can see, this is a bullish engulfing candle, signifying that this bullish engulfing is bigger than the previous three candles, as we can see, and it shows that we are reversing to the upside. We are continuing the trend to the upside, including this is a bullish engulfing candle that is bigger than the last 5 candles, and we can see that it shows that the trend will continue to the upside. And as we can see here is a bearish engulfing candle engulfing the previous 5 candles, proving that it is going to move, that is showing that there are sellers, strong amount of sellers in the market, and shows that we are going to reverse to the downside. Now for effective trading, we have to wait for confirmation of this pattern. This could be another candle in the direction of the engulfing candle pattern. So after the engulfing candle, we have to wait for another candle in the direction of the engulfing candle before we take our trade. Engulfing patterns are more reliable when they occur at key support or resistance area. It has more value, or it holds more value when we spot these engulfing candles at key resistance or support area. Let's not forget to always manage our risks with appropriate stop loss when trying to enter the market using an engulfing pattern. It helps us to protect ourselves against unexpected market movement. Now the next pattern we'll be looking at is called the morning star candlestick pattern. The morning star candlestick pattern is a three candlestick pattern that signals a potential reversal from a downtrend to an uptrend. It represents a shift in market sentiment. It's a, it's, it refers to a shift in market sentiment where sellers pressure are weakening and buyers are stepping in to take control of the market. This is what the morning star candlestick pattern is all about. Now let's see how it forms. It forms by the first candle is a long bearish candle, or it has to be a long bearish candle, sorry. The first candle has to be a long bearish candle. The second candle is a small bodied candle, and it can either be a bullish candle or a bearish candle. It doesn't mean for the second candle, it has to be either bullish or bearish candle, indicating indecision or a pause in the trend. While the third candle has to be a strong bullish candle. It must be a strong bullish candle that closed well above the body of the first candle, confirming the reversal. It has to close above the body of the first candle, confirming the reversal, showing that there are strong bearish sentiments in the market. This pattern typically appears after a prolonged downtrend, and it signals buyers are regaining control. Now let's spot this pattern. As we can see on the chart, we can see this is an example of a morning star candle where the bearish candle coming from a downtrend, a prolonged downtrend. Then we see an indecisive candle, a small indecisive candle. Then we see a bullish engulfing candle, signaling that buyers are coming back into the market. Now, how do we trade the morning star? We wait for confirmation from the third candle. As long as the third candle close above the midpoint of the first and second candle, this confirms that the reversal is likely to hold. For additional confidence, you have to look for the pattern near a key support area and combine with other indicators like the RSI. If you combine it with other indicators, it holds more value. Now the last candlestick pattern we are going to be talking about is called the shooting star candlestick pattern. Now the shooting star candlestick pattern is a single candlestick pattern. This pattern that signals a potential reversal from an uptrend to a downtrend. It indicates that market may lose its upward momentum when sellers begin to take control over the market. Now let's look at some characteristics of the shooting star candlestick pattern. First characteristics is it has a small real body. It has a small real body at a low end of the trending range and has a very long upper shadow. It must have a very long upper shadow, at least twice the length of the body of that candle. Little to no low shadow. It has little or no low shadow. Typically appears at the top of an uptrend. This appears usually at the top of an uptrend. This pattern suggests that buyers push price higher during the section, but by the close, sellers have driven the price back down near the opening level. Now let's look for this pattern on the chart, and as we can see, we can spot our shooting star at this area. This is our shooting star. After an uptrend, you will see a shooting star signifying bears are trying to come into the market. And this is also an example of a shooting star that comes into the market. This red candle over here, this signifies the bullish market. The bears came into the market at the dying minute to push price lower. Now let's see how we can trade a shooting star. We have to look for confirmation in form of a bearish candle that indicates selling pressure is likely to continue. So after the shooting star, it is more effective when you see a bearish candle comes after the shooting star candle, and the shooting star is more effective when it occurs near a resistance level. It has to occur near a resistance level to see a strong shooting star candle, and it occurs after a strong uptrend. It occurs after a strong uptrend. As you can see, if we want to enter the trade using the shooting star after our shooting star candle and we see a next bearish candle, we can enter the trade at that area, putting the stop loss just above the swing high. Then we aim for a 1:2 or 1:3 as the case may be. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your trading experience. If you found this video helpful, do not forget to like and subscribe. Turn on the notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.